In November 2025, Netflix stock dropped sharply. On a split-adjusted basis, the price opened near $111 after a 10-for-1 stock split, giving the illusion of a 90% crash. But that wasn't the real story. Even beyond that, the stock has slipped significantly. Investors have sent shares down substantially since its mid-year highs. The main trigger was the company's Q3 2025 earnings. While revenue grew about 17% year-over-year to $11.51 billion, matching expectations, earnings per share came in at $5.87, well below forecasts. That miss was tied to a one-time tax charge tied to a dispute in Brazil. Margins took a hit, which upset investors, even though Netflix said the tax charge was a one-off and its overall business, subscriptions ads, remains healthy. There's more than just accounting drama. Analysts and investors are increasingly uneasy about Netflix's next growth phase. Questions about how it'll compete with rising streaming competition and whether any big acquisition or deal strategy, if attempted, might backfire. Technically, the stock broke important support levels. That amplifies selling pressure as chart-based traders and algorithms react. The result, for many investors, what once looked like a high-octane growth story now feels riskier. The slip may shake confidence, especially among those focused on near-term returns. But for long-term believers, the fundamentals, subscriber base, content library, ad revenue, are still there. Some analysts argue the drop might be a buying opportunity, if Netflix can execute. So, is this a scare or a dip worth buying into? That depends on what you believe: risk and uncertainty, or long-term growth and resilience. Either way, watch Netflix carefully over the next few quarters. What do you think? Bargain or bubble? Drop a comment below.